Today, we will be discussing about liabilities. This is one of the 5 main elements of a financial statement that you need to understand in order to have a good grasp of the accounting process. But before we go through all of that, I would like to welcome you all to Accounting Zero to Hero. We are here to help you understand the fundamental accounting concepts through simplified technical discussions and practical applications of the accounting standards. All of this to help you go from zero to hero. Now let's go back to the video. As before, we will start off by looking further into the practical definitions of a liability. And then, we will investigate what the standards are telling us about it. And we will cap off the discussion by examining the actual financial statements of a listed company. So in most simple terms, liabilities are everything that you owe to another counterparty. You will notice that this is a very safe definition because when you extinguish a liability, it is not always cash. Although cash is the most common way to pay a liability. In other words, liabilities are claims on the assets of the company or claims on the resources of a company. Leveraging on the discussion from the previous video, other than those of the owners. So for example, if assets are represented by this rectangle right here, if the assets are the resources of the company, the liabilities are one of the two types of claims on those resources. As you can see on the screen, it is how you will split the assets at any point in time. So right now, I split it half, 50-50. But it's not always like that. The first half are the liabilities. Meaning that we need to spend this much of assets in order to pay our liabilities if we prepare a financial statement right now. The second half of the illustration are the equity. Meaning these are the remaining assets after we pay all of our liabilities. So this is what we mean by saying that the liabilities are claims on the assets. Everyone, I assume, will be familiar with liabilities because these are normal personal and business transactions. If you understood the concept of a receivable as an asset, if you switch the point of view, the person expected to pay the other person has a liability to that person. So right now, imagine if you have an obligation or a liability to pay a friend, for example, $100. You have a liability of $100, but then you have a $500 at the bank. Those are your assets. I want to emphasize that liabilities exist independent of your assets because these are merely claims, and this will remain as claims unless you actually pay the liability. In this example, as long as you did not make any actions to transfer money to your friend, you have to report 500 of assets in the bank. Then, liabilities of 100 with equity of 400 remaining. So continuing with our illustration, we have 500 of assets split into 100 of liability and remaining 400 of equity. The equity we will be discussing in future video, but I think it is very helpful to discuss them now because you will see that there's a difference between the assets and the liabilities. But you can worry about that later. So you see, assets remain intact even if you have a liability. You cannot net it off in the presentation because the users of financial information need to know both information. Number one, what resources do we have? And number two, what sort of claims do we have on those resources so that we will know how much is remaining for us as the owners of the company. So continuing on all of these discussions, another thing to note here is that to help you understand several accounting literature, the person expecting to be paid is called the creditor. So for example, if you have person A and person B, and person B has to pay an amount of, for example, $50 to person A. So we discussed before that person A has a right to collect from person B of $50. But if you switch the point of view, person B now has an obligation to pay person A $50. So in the eyes of person B, person A becomes the creditor. So it's very important to remember or understand the term. You have to know the different types of point of view to be able to apply the different terms, the different accounting terms that you will encounter in several literature. As you learn more and more about accounting standards, you will encounter different types of liabilities being covered. So it's important that you know the technical definitions of a liability to be able to apply them whenever you encounter different types of situations at work or even in your exams. Same as in the previous video, technical discussions can be found by reading two main sources. We have the first, the Conceptual Framework of Accounting, which sort of acts as the constitution of accounting since standard setters use this as basis when drafting new accounting standards. I have linked the Conceptual Framework below so that you can see the full text. The second one is the IS1 Presentation of Financial Statements. Both of these will be discussed further in the succeeding slides. Under the conceptual framework, the definition of a liability is covered in Chapter 4. In it, you will find that a liability is one of the 5 main elements of a financial statement as discussed before. We have the asset, the first one, the liability, what we're discussing right now, equity, income, and the expenses. So if the assets pertain to the resources, the liability is one of the claims on those resources. So under the conceptual framework, a liability is a present obligation to transfer an economic resource as a result of past events. Under this definition, for a liability to exist, 3 criteria must all be satisfied. Number 1, the entity has an obligation. Number 2, the obligation must be to transfer an economic resource. And number three, it should be a result of past events. Let's look at these 3 in detail. The first criterion for a liability is that the entity has an obligation. An obligation is a duty or responsibility that an entity has no practical ability to avoid. So an obligation or a liability is always owed to another party or parties. However, according to the conceptual framework, this party or parties could be a person or another entity. Could be a person or an entity. It could either also be a group of persons or entity. And it can even be the society at large. So it goes to show that it is not always necessary to know the identity of the party to whom the obligation is owed. Sometimes it is uncertain whether an obligation exists. For example, if another party is seeking compensation for an entity's alleged act of wrongdoing, it might be uncertain whether the act occurred, whether the entity committed it, or how the law applies. Until that existence uncertainty is resolved, for example, by a court ruling, it is uncertain whether the entity has an obligation to the party seeking compensation and consequently, whether a liability exists. So, what are the sources of these obligations? Many obligations are established by contract or legislation and are legally enforceable by the party to whom they are owed. However, obligations can also arise from an entity's customary practices, published policies, or specific statements, if the entity has no practical ability to act in a manner inconsistent with those practices, policies, or statements. The obligation that arises in such circumstances is sometimes referred to as constructive obligations, meaning, for example, if they already promised a bonus to the employees and it's customary for them to give a bonus, they should recognize a liability on those bonuses even if they have not yet paid them. So this is not legal, but it is customary, or it becomes a constructive obligation. The second criterion for a liability is that the obligation is to transfer an economic resource. So as you know from the first video, when the conceptual framework says an economic resource, they mean an asset. They didn't specifically say cash, although it is the more common way of extinguishing a liability, but you have to give up something. You have to give up a resource in order to extinguish a liability. So that is the second criterion. To satisfy this criterion, the obligation or the liability must have the potential to require the entity to transfer an economic resource to another party. The obligation can meet the definition of a liability, even if the probability of a transfer of an economic resource is low. Nevertheless, that low probability might affect decisions about what information to provide about the liability. So if it's low, you have to decide what information to provide in terms of disclosures. The probability can also even be a factor in determining whether a liability is recognized or not, or just merely disclosed. Some examples of obligations according to the framework under the transfer of economic resource are the obligations to pay cash. So number one, that's pretty straightforward. Obligations to deliver goods or provide services. The obligation to exchange economic resource with another party on unfavorable terms. Obligations to transfer an economic resource if a specified uncertain future event occurs. So as we can say, even if the probability is low, you have to recognize the liability. Obligations to issue a financial instrument if that financial instrument will oblige the entity to transfer an economic resource. All of these examples are enumerated under the conceptual framework. So if you're taking an exam, it's better to have them familiarized so that you will be ready for any questions. The third criterion for a liability is that the obligation is a present obligation that exists as a result of past events. Past events, but present obligation. A present obligation exists as a result of past events only if, number one, the entity has already obtained economic benefits or taken an action. And number two, as a consequence, the entity will or may have to transfer an economic resource that it would not otherwise have had to transfer. So the most practical example I can think of here is when you obtain services from a supplier and you have not paid yet. The past event is the action by the supplier, for example, delivery of the goods you ordered, since you already benefited from the action. You now have the obligation to pay them in the future. So this pretty much covers the definition of a liability according to the conceptual framework. You will notice some parallels within the definition of an asset And I would like you to take advantage of that in making yourself familiar with both definitions of assets and liabilities. So now we will now go to the definitions of a current and non-current asset under IAS 1. As you know, IAS 1 covers the presentation of liability accounts that are not discussed in the conceptual framework. It does not contain the definition of a liability. The standard says that an entity shall present current and non-current liabilities as separate classifications in its statement of financial position, except when a presentation based on liquidity provides information that is reliable and more relevant. When that exception applies, an entity shall present all assets and liabilities in order of liquidity. So same as in the assets, we have current and non-current classification of liabilities as required by the standards, and we're going to discuss them in detail. So how do we know what is current and non-current? You will notice that this definition mirrors some of the definitions of a current asset except for the last part. An entity shall classify a liability as current when, number 1 is it expects to settle the liability in its normal operating cycle. This is the same operating cycle we discussed in the previous video, which is the average period in which we complete the cycle of acquisition of inventory from a supplier to its realization in cash from a customer. When the entity's normal operating cycle is not clearly identifiable, it is assumed to be 12 months. The second one is that the entity holds the liability primarily for the purpose of trading. This definition relates mainly to liabilities that are traded in formal exchanges. If we have these types of liabilities, we expect to settle them in the short term, sometimes even a few days, and they are valued at fair value. The third one is if the liability is due to be settled within 12 months after the reporting period. So for example, if you're accounting for company A, you have 3 periods here. This is the reporting period of 12 months. This is the end of year X plus 1, end of year X plus 2 years. So if you're doing an accounting as of this period, a financial position or a financial statement as of this period, and it's saying that the liability is due to be settled within 12 months after the reporting period. So it is current if, as of this date, you have a liability that is due to be paid as of this date. Then it is a current liability. But if the liability is due to be settled as of this date, it's a non-current liability. The last one is one of the more interesting parts of the analysis of a current and a non-current liability. It says that it does not have an unconditional right to defer settlement of the liability for at least 12 months after the reporting period. If the company, again, does not have the unconditional right to defer settlement, then it is a current liability. For example, this is company A, in which they have a liability to company B. They have a liability of, let's say, $500. Under this criteria, when is the liability non-current? So, if the company A has an unconditional right, the company A is the one with the liability. If company A has an unconditional right to tell company B that, no, I will not be paying as of this date, then it is a non-current liability. Why? Because company A has the right to say no, even though as per the contract, it's saying that you should pay as of this time. Company A has a sole discretion to say no that I will not be paying. I will be paying as of this date, for example. Then it becomes a non-current liability, even though per contract it says that it should be paid within 12 months. So you have to check the contract, the specific provisions of the loan contract before you give any conclusions of whether it is a current or non-current liability. So the discretion should be on the company that has the liability. If the discretion is with company B, it doesn't actually make any impact because if company B has a discretion not to ask for payment, then company A will just look at the normal due date and they will not assume that company B will be giving them any extensions. So you have to remember that it depends on the point of view. The discretion to defer should be with the company you are accounting for. I hope that's clear. So the entity shall classify all other liabilities as non-current. As with the assets, this is a very residual definition. We are now going to discuss some common current liabilities that you will see in the financial statements. So number one, we have the trade payables. The trade payables are current liabilities because they are due to be settled within the normal operating cycle of the business. Okay, so these are normally coming from unpaid suppliers of goods and services. So since you already benefited from the goods that have been delivered to you or the services that have been rendered to you, you now have the present obligation to pay them in the future. So next are the bank overdrafts. These are coming from checking accounts with the banks, and they are expected to be settled in the short term as well. The third one is the current portion of the bank loan. This is the portion of a long-term loan. Long-term loan that is due to be settled within 12 months after the reporting period. So for example, if you have a long-term loan of around $300,000 or $300, and you need to account for at this year x plus 1 and x plus 2. If your loan is actually under staggered payment terms, so in year 1 you need to pay it around here 100, year 2 100, and another in year 3 100. So your long-term loan is actually split into two: the one that is current, which is the 100 here, and the 200, which is non-current, which are the other 100, the other 200 in the succeeding years. So the first 100 is actually qualifying as a current loan, even though the whole loan is actually long-term in nature. Deferred tax liabilities, same as deferred tax asset. This is covered by IAS 12, and according to IAS 1, the one we discussed before, this is a non-current liability and it can never be current. These are always non-current liabilities. So for long-term bank loans, so from the name itself, it's a long-term bank loan, which means that it's going to be paid more than 1 year after the end of the reporting period that you're accounting for. Normally, bank loans extend for, I think, 2 to 5 years, so they will be long-term. Unless your bank loan is expected to be paid within the next year, then it should be short-term. It should be classified from long-term to a short-term bank loan. So to connect our discussion on the assets of Tesla in the previous video, we will discuss their liabilities next. To do this, I do this because I find it important to be able to connect your theory to see how they are being applied in actual practice. For this one, I will only discuss the portions which we have covered in the video to further illustrate the lessons. So you will see that they're also presenting their liabilities in two parts. These are the current liabilities and the non-current liabilities. In their liabilities, they have the accounts payable or the trade payables, the accrued liabilities, or this can be qualified as advanced services. Deferred revenue is something that we have not discussed yet, but I can add this now. Deferred revenue is when a customer pays the company in advance. So when the customer pays the company in advance, you have a liability because you have the obligation, to deliver the service to the customer. So it becomes a liability. So we also have other types of current liabilities that are disclosed by Tesla. Then we also have the current portion of debt and finance leases because your debt, for example, your long-term liabilities should be split between long-term and short-term. You have, for example, if you have a total liability of $100, you have to split this in your financial statement to have the, for example, the $10 that are going to be paid next year. And then you have the $90 that's going to be paid in the coming years after next year. That's why we have this current portion and then debt and finance leases net of the current portion. So that's important to take note. So I think this is it for now. I hope you learned something from this discussion. For the next video, we will look into the equity as an element of the financial statement before we pause for a break to discuss the accounting equation. It's going to get exciting, so don't forget to subscribe and click the notification bell to keep yourself updated. See you!